We are in the the grandmother of all stock market bubbles. And almost nobody is calling it what it actually is. Everyone says this time is different. The AI is real. The demand for tokens is insatiable. These companies are profitable. And according to select metrics, they are not wrong. But I'm going to show you why that doesn't matter and why this is one of the biggest warning signs. Because what you're seeing unfold is the same as every bubble that came before it for the last 200 years. Nearly word for word, and it ends the same every single time. If you own a 401k, you are essentially already on the wrong side of this trade. Already exposed, and you don't even know it yet. And one of the world's largest economies has descended into a speculative fervor, with a stock market mania, the likes of which have not been seen since 1999. An entire nation chasing highs, unwittingly giving the smart money a clean exit. And the United States is right behind them. And this week, the government and the smart money signaled exactly how they are positioned for the burst. In this video, I am going to show you 4 things. First, the 2 metrics that have predicted every major bubble in history. Both are higher right now than at any prior peak. Higher than the dot-com crash, higher than 1929. In fact, higher than both of them combined. Second, why the country I just mentioned, overtaken by stock market gambling, is the canary in the coal mine, and why what's happening there is a real-time preview of what's coming everywhere else. Third, why the biggest IPO in history, SpaceX, is the biggest red flag imaginable, and why the Nasdaq just rewrote its own rules to rush it through before you noticed. And fourth, why the country with one of the highest per capita Bitcoin ownership percentages in the world is one of the clearest warnings to every Bitcoin holder about what happens when you stop stacking and start chasing. The railroad bubble of the mid-1800s, the radio bubble of the early 1900s, and the dot-com bubble of the early 2000s. They all looked the same, they all sounded the same, and yet 99% of the people never realized they were in the middle of a giant bubble. Until it was too late and the music stopped. I ran the numbers and I compiled the charts, and the headlines do not match the math. I'm going to show you the metrics, explain what follows, and tell you exactly what you can do, including why the asset that TradFi considers the most dangerous has been the most boring in the market for the last 6 months. Because as stocks have been hitting new all-time highs, Bitcoin has done, well, nothing. And I'm going to explain why that boredom might be the single biggest threat to your stack, and why the moment that things feel the most boring is actually the most important time to hold. It's all fun and games until the music stops. And when it does, you'll want to be as far from the dance floor as possible. Let's get into it. Okay, part number 1, the math behind it all. If you're like most people these days, you've taken the financial advice of putting your money into an index fund. You throw your money in, it gets sprinkled amongst all the best names in the world, and you think you're diversified. But in reality, that's wrong. Take $1,000. Put it in the most popular index in America, the S&P 500. 300 of those dollars buy 7 companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla. 30% of your money is in just 7 names. The other $700 gets spread amongst 496 companies like finely cut up crumbs. Now let's look at what's actually pulling that index up. Add 4 more chip stocks: Micron, Broadcom, AMD, Intel. And you have over half of the market's entire gain coming from a single sector. The other 495 names, the ones you think you're diversified into, are mostly flat. The median stock in the S&P 500 is sitting 19% below its all-time high. The index is at a record, but many of the companies inside of it are not. But here's the part that should really open your eyes. This is a chart of stock market concentration going back to the 1830s. The share of the entire market held by its biggest handful of names plotted across the last 200 years. The railroad bubble of the 1800s, the radio and electric boom of the 1920s, the Nifty 50 in 1972, Japan in the late 80s, and of course the dot-com bubble in 2000. Looking back, every one of those spikes was a major bubble, and every single one was followed by a major crash. For most of history, the market sits down here, 15 to 20% in its biggest names. It only ever climbs to 40% at the top of a mania, not in the middle, at the peak. And right now, 10 companies driving the AI trade, the Magnificent 7 plus Broadcom, Micron, and AMD, are 40% of the entire US stock market. We are standing on top of this spike. You already know what happened to the other 5. And now the 2 other metrics that are screaming bubble. The Shiller Cape sits at 42 today. We are just 1 notch below the most expensive market in modern history. The Buffett Indicator, total market cap divided by GDP sits at 237%. In 2000, at the dot-com peak, it hit 146%. In 1929, 95. Today, it is higher than both of those bubbles combined. And lastly, the simplest measure of all, the Nasdaq divided by every dollar in the US money supply. This is how expensive stocks are after controlling for money printing. Today's reading is the highest in 50 years. Higher than the dot-com peak. Even after a generation of the Fed expanding the money supply by trillions of dollars, this market is still more stretched than the crash that wiped out the retirement accounts of countless Americans. That's how an index can lie to you. The headlines can disagree with the underlying math for months. The viewer watching CNBC in February 2020 thought the bull market was healthy, but the numbers were telling a different story, and that story is repeating right now. Your 401k is the AI trade. Your pension is the AI trade, stacked on top of valuations that have only been matched once in a century, and crowding that has only been matched twice. And there's a country that's about to show us what happens when a trade this concentrated finally unwinds. That country is South Korea. Now on to part 2, Korea, the canary in the economic coal mine. Now, before I show you what's going on in Seoul, do one thing for me. If you've made it this far in the video, comment the word canary down below. I want to see who's still with me. Korea is the canary in the global financial coal mine. When a cycle turns, the market that cracks first is always the most fragile, the most leveraged, the most retail-driven, the most concentrated. And right now, you could argue that there is no market more fragile on earth than Korea. So let's look at it closely to see what the blow-off top of an AI bubble actually looks like. Okay, so there's this Korean company called Parents Love. It sells funeral packages like flowers and caskets and burial services. Elderly Koreans pay a small amount every single month, sometimes for decades, so that when they die, their children will not have to scramble for the cost. This is literal casket money paid in advance and held in a trust. But in its latest audit disclosure, the public found out that this company, Parents Love, had been swept up in the same mania as everyone else. The company had taken 59 billion won of that prepaid casket money and put it into a 2x leveraged ETF tracking Tom Lee's Ethereum treasury company. That position has imploded and is now just worth 10 billion won. They lost 49 billion won, 8 times the entire annual revenue of the business. Every grandmother who paid in every month for decades had her casket money taken and gambled away, using margin, literally double or nothing, on a cursed Ethereum stock, Bitmine Immersion Technologies. And most of these grandmothers don't even know it yet. Their children will find out when they die, when they're handed a bill for a funeral that they thought was paid for. Okay, but Parents Love is not alone. This whole country is doing some version of this. In Seoul, last month, a 70-year-old man walked into a brokerage, linked his bank account overdraft to his trading account, and said, if I max out my overdraft, I think I can buy 10 shares of SK Hynix. It was his first stock purchase in 20 years, and he bought them all on borrowed money. We've got a 70-year-old woman in Gangnam. She sold all of her Samsung shares at an all-time high in a bull run. I mean, look at this chart. She sold it not to save the money because she wanted something doing more. That is what an entire society gripped by FOMO looks like up close. A Korean civil servant put $1.7 million into the stock SK Hynix, the company that makes the memory chips that go inside the world's AI servers. About 1.2 million of that was borrowed. He posted a screenshot of this on his workplace app, bragging. 4 days later, he posted again that he was up $200,000. A Seoul Metro employee in her 20s took a 150% margin loan, borrowing more than her account was even worth to go all in. Her words, I would rather risk complete collapse than miss out. We've got Uber drivers in Korea checking their trades at red lights, supercar dealerships full of chip stock employees, and it's become a flex to wear a SK Hynix vest on a first date in Seoul. The whole entire country is betting on margin on the stock market, and even the retirees are getting involved. This is what it looks like when a mania sweeps an entire country. The young pile in first, then the middle-aged who get jealous of their coworkers, and then last of all, the people who should know better. The ones who spent 40 years never touching the stock market because they swore it was too dangerous. These are the entrants that come in at the very top. They have the most to lose and the least time to make it back. In Korea right now, the old are all in. 62% of all Korean margin debt, money borrowed to buy stocks, is now held by Koreans over the age of 50. Their margin balance has doubled in a single year. We're not talking about the terminally online 20-somethings. These are grandparents. Life insurance cancellations are up 16% in a single quarter as people surrendered their policies that were meant to help their family after they're gone so they could go all in on chip stocks. Bank deposits fell below 100 trillion won for the first time in 4 years. Overdraft loans have hit a 3-year high. And the brokerages lending all this margin at 7 to 9% interest, yeah, they just booked their best quarter in history. The brokerages are getting rich, and a whole bingo hall's worth of grandmothers are about to get margin called. Foreign investors are selling Korean stocks faster than at any point in the country's history. We're talking 13 sessions in a row by the world's largest institutions, even as the index continues to tear to new records. In March alone, foreigners pulled $36 billion out of Korea, the largest single month of outflows since records began in 2007. And of course, who is buying everything that they dump? Korean retail. Ordinary people handing the smart money its exit. The stock at the center of it all, SK Hynix, went from under $100 billion to over $1 trillion in just 16 months. South Korea is now the second country in history with more than $1 trillion company on its exchange. Samsung at $1.3 trillion and SK Hynix at $1 trillion. These two companies are now half of their entire stock index. You see, Korea is the canary because it is built to crack first. It's the most leveraged market, the most retail driven, and the most concentrated. That is always the one to go when global risk appetite turns. A funeral fund down 8 times on a leveraged bet on Ethereum. Grandmothers cashing out their life insurance to chase the rally. The smartest money on earth heading towards the exit, while ordinary Koreans buy up everything they sell. The canary is suffocating on leverage, and the United States better pay attention because it could very well be next. Okay, part number 3. They are ringing the bell. How does this end over here in America? Sure, stocks are high, but it's not the same thing as Korea, right? Well, every great mania of the last 100 years runs the same playbook. The smart money starts to take chips off the table, the forecasts get louder and louder, and then a giant IPO shows up to ring the bell at the top. Then it's over. We saw this in 1929, 2000, and now it's happening again. Step 1 is in motion. The smart money is already starting to exit from Korea. Step 2 is the forecast from the big banks get outlandish. JP Morgan just raised its target for Korea's stock market to 10,000. But it's not just the banks making outlandish calls. This last week, NBA player Tristan Thompson, the man who won a ring with LeBron and had a baby with a Kardashian, posted his investment thesis on robotics, humanoid automation, machine vision, semiconductors, and industrial test infrastructure. When pro athletes are publishing semiconductor theses, the forecasts are about as loud as they can get. Every top has its version of the shoeshine boy, and this was ours. And that brings us to step number 3. It's happening right before our very eyes, and few are talking about how ridiculous it is. Over the last couple of months, the Nasdaq has done something that it has never done before. It rewrote the rules of its entire index for a single company. SpaceX is lining up to be the largest IPO in history, a $1.75 trillion valuation, which would make it the 6th biggest company in America on day one. Normally, a new stock has to wait 6 to 12 months before it can join a major index. The waiting period exists to protect ordinary investors from being shoved into an untested stock. But for SpaceX, Nasdaq cut that period to just 15 trading days. And normally, when only a sliver of a company's shares actually trade, the index weights it by that small real float. But to accommodate SpaceX, it will weight thin float stocks at 5 times their real size. You put these two bending of the rules together, and this is what you get. Every QQQ holder, every NASDAQ indexed 401k, every passive fund on earth gets forced to buy hundreds of billions of dollars of SpaceX into a pool of shares that barely exists. Elon Musk, he keeps 85% of the voting power. And 3 to 6 months after listing, when the insider lockups expire, those insiders get to sell straight into all of that forced buying. Your 401k that is heavily weighted into the NASDAQ, yes, it is literally the exit liquidity. When Wall Street starts to rewrite the rules to manufacture buyers for one IPO, you can say that the top is pretty much here. Now, let me be straight with you about something that most videos like this will not admit. Tops do not ring a bell that you can actually hear. This thing could run for another 6 months, maybe another year. The whole nature of a blow-off top is that nobody can tell you exactly where it ends. So I'm not telling you to short anything. I'm not telling you to sell everything you own. I'm not even telling you to bet against AI. All I can say is don't chase it. If you've got money that you can genuinely afford to lose, money you can watch fall 60 to 70% and still hold for 10 years, and you want to take a swing, that's your call. This is not a bunker down, sell everything video. This is a don't blow yourself up video. Think twice before putting money that you'll actually need into stocks at record valuations. Don't take on leverage that you couldn't survive a margin call on. Because after a stock market peak, sure, these stocks can come back eventually. Some take a few months, some a few years, but some of them never come back at all. And maybe you're thinking, but Nvidia, AI, this whole trade, it's completely different than anything in past history. But every single cycle has one stock that everybody swears is the exception. Let me tell you about Cisco. In March 2000, Cisco was the most valuable company in the world. It was profitable, revenue growing at 40% per year. It built the infrastructure that the modern internet still runs on today. The stock fell 89% from its peak. 26 years later, it still has never gotten back there. The technology was real, the profits were real, the stock was still in a bubble. Those things were never in conflict. That is just the reality of what a bubble actually is. Howard Marks, the man who wrote the book on market cycles, has been saying the same thing for 50 years. The riskiest thing in the world is everyone believing there is no risk. That belief is everywhere right now. From Wall Street to the Korean grandmother cashing out her life insurance. When nobody can see the risk anymore, that is exactly when it's at its highest. And then we have Charlie Munger, Warren Buffett's right-hand man, who spent 60 years repeating one line. The big money is never made in the buying. It was never made in the selling. It was always made in the waiting. The trade that wins the next decade is the one that is the most boring right now. Let me share with you what I think it is. Okay, part number 4, the trade of the decade. This whole entire video so far has been about the problem. Let me share with you what I think is the answer. The most boring asset on the planet right now is the one with the most asymmetric upside, Bitcoin. It's sitting around $73,000 as I record this, down roughly 25% for the year. It's stuck in the same range for the last 6 months. Stocks like Samsung and Micron have more than doubled. And the S&P is up over 10% despite an unprecedented energy shock. And Bitcoin is just sitting there doing nothing. So if you're watching this and feeling the itch to sell your Bitcoin to chase the chip stocks instead, I've got some bad news for you. You're the Korean grandma. And here's why it's so hard to sit still. Doing nothing feels wrong. Every day, Bitcoin stays flat while stocks scream higher. It feels like you're missing out while everybody else is getting rich. Your brain simply cannot handle it. This is activity bias. It is your brain telling you you must do something. And the market is happy to feed that. The headlines, the green candles, all the flashing lights to give you dopamine to keep you playing. But holding through the boredom is the whole work. Patience is the point, and hodling is not easy. You see, all of Bitcoin's gains in any given year come from just 10 days. Not 10 weeks, 10 days. In 2024, the 10 best days returned 52%. The other 355 lost you 15%. In 2018, deep in a bear market, the 10 best days still returned 180%, while the rest of the year bled you out 91%. It happens every year, and you cannot predict which 10 days it will be. No one can. The only way to catch them is to already be sitting there when they hit. People chasing the parabola will not be there. They'll be off chasing the next hot thing. The only ones who will catch those 10 days year after year are the ones who never left. And you know what's funny about this whole entire situation? Jeff Park puts it bluntly. Korea has one of the strongest Bitcoin cultures in the entire world. The same country that is betting it all on chip stocks at the top is one that got into Bitcoin extremely early, charges zero capital gains tax on it by law, and treats it as a reserve held by the people themselves. So while some Koreans are going all in on the stock market casino, others are patiently waiting with Bitcoin. The same country, 2 options. One is packed, the other is simply not right now. You get to choose which one you pick. If this video opened your eyes to what other people are not seeing, do me a favor. Like it, subscribe, and send it to the one person you think who is about to throw their entire life savings at the AI trade. That's the whole ask. Munger said it in one sentence. The big money is in the waiting. You can be the patient one. You can do nothing while the whole entire world scrambles at just the wrong moment. And on those 10 days a year, every year, for the rest of the decade, you'll be the one who's there to catch them. So when the bell finally rings for this bubble, you'll be on the side you want to be on. All you got to do is wait.